So after yesterday's Fed meeting, apparently the market didn't like what it heard because we saw the second largest VIX Index spike in history. Going back 35 years now to 1990, yesterday's 74.04% VIX spike is right there at number 2 all time, only outdone by Volatility in February 2018. And remember, we're coming off what was the previous number 2 all time just a few months ago in August, and the number 25 all time in September. So clearly the VIX Index is having some wild days lately. Now, unfortunately for short volatility traders, the previous day was completely calm. You can see 7.65% VIX futures contango. No reason not to be in the market, so I would imagine that everybody who shorts volatility got hit by yesterday's spike. It is what it is. Sometimes you just don't get any warning signs ahead of time. But what I want to talk about today is a super common question that I get every time the market has one of these insane volatility spikes. Scott here asks, when the market crashes later in the day, even though the official trade signals have already been sent out, should we close out all of our positions anyway? So to answer this question, that email part of it is important. Here at VTS, I send out the official trade signals for all of our strategies around 11 a.m. Eastern Time. The official cutoff is noon, but I do try to give people some extra time. And importantly, no matter what happens in the market, I will only ever send one email per day. There will not be a second follow-up email changing any of those positions. Yesterday's massive VIX spike happened after I had already sent out the official trade signal, so whatever positions we were in, those are the trades for the rest of the day. My system is that I will always wait for the next day and then use the most up-to-date volatility data to make the new trade decisions. We're basically functioning on one-day timeframes here. Now, of course, if the previous day did have a big market crash, it's quite likely that would push our volatility metrics to higher ranges and move our strategies to safety positions. But to answer the question, we will never switch positions twice in the same day. Well, why? Why not dump everything as soon as we see the market crashing? Well, emotionally speaking, it does make sense that people are going to feel that panic and just want to dump everything. But mathematically, that can be a very costly thing to do. Let me show you why. So again, here's our list of the top 25 VIX Index spikes going back to 1990. And I do also list the S&P 500 movement the same day, plus the S&P 500 movement the next day. This is the column I want to focus on. If you look at those values, you'll probably notice that most of the time, the S&P 500 does have a little relief rally the day after big volatility spikes. Not every time. There's a couple on there where the market crashed and then it just kept going the next day. But 75% of the time, the S&P 500 is up the next day, and a few of them quite significantly. 9%, 6%, 5%, and several of them 1 to 2%. It's pretty common. And this next day relief rally is even more pronounced in the volatility markets. The VIX Index and all of the volatility ETPs can very easily retrace some of what was lost. If you're in the habit of exiting your positions during the day every time the market crashes, well, yes, there are a few times that turns out to be the prudent choice because markets can go from bad to worse. But mathematically speaking, 75% of the time you end up just locking in those losses at the end of the day that would have partially recovered the next day. Going by the numbers, and this is what we do as quant systematic traders, long-term performance is better if we just stick to that one trade per day schedule. Now, if necessary, of course, we will calmly exit the market the next day if the volatility metrics show that. We're not just going to let it go for multiple days in a row or anything. That could be very costly. Remember, there is no way to avoid getting hit sometimes with those single-day volatility spikes. If the market goes from calm to panic, then it's going to catch everybody off guard. The real goal of short volatility trading is to avoid the extended drawdowns by having signals that can move us to safety before the damage starts piling up. This is a chart showing the drawdowns in the minus 0.5 times short volatility ETF called SVXY. Now, in yesterday's second largest VIX spike in history, the SVXY did go down about 8%. That's a gut kick. But if you don't have signals to move yourself to safety the next day or the next couple days, then that 8% drawdown can quickly go to 30, 50, or even 70%. One-day hits are impossible to avoid, but multi-day extended drawdowns, this is what we're trying to reduce. So to answer the question, no, we won't come back a second time and adjust any of the positions. Mathematically, it is better to just recalculate the new positions the next day and stick to the system. So now you need to check out this video here that explains our flagship tactical volatility strategy, or this video that explains my comprehensive volatility barometer that we use for our trade signals. Long term, I think that all investors out there should have some short volatility exposure, so feel free to check out how we do that at VTS.